Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra. Well, the official figures for the gross domestic product or the GDP data for the Q2 of fiscal year 2024 is scheduled to be released tomorrow. That's November 30th by the National Statistical Office. And though the RBI Governor Shaktikanta Das has said that India's Q2 GDP numbers will surprise everyone, most of the street estimates peg the Q2 economic growth between 6.5% to 7.1% as well. The big question is, will the Indian economy continue to post stronger, better than expected growth numbers even in Q2 as well? Joining in to help us really understand what can we expect from Q2 GDP numbers tomorrow and what does that mean for the economy and the consumers at large as well. Rajani Sinha, Chief Economist, Care Ratings, now joins in. Rajani, welcome to Business Today Television. It's always great to have you with us and help you, discuss, share some insights with all our viewers what the economy is looking like, what the status of the economy is, what are we expecting and where are we headed from here. So the first question coming your way is, as far as the Q2 GDP numbers are concerned, what is your own expectation? Like I pointed out, a string of data points are coming in. A lot of brokerage houses have been pegging in your own numbers, their own numbers. What is your own expectation here on the headline number?
Sakshi, we are expecting Q2 GDP growth at 6.5%. But like you mentioned, there are chances, in fact, of this number being higher than what we have projected. I compare it to Q1 number of 7.8%, we are talking about a deceleration. But we have to note that it's mainly because of waning of some of the base effect that we had seen in the first quarter. Otherwise, if you look at 6.5%, which is our expectation for second quarter, I would say it's a decently good number, and it is going to be led mainly by the services sector. As we have seen in the previous quarters also, for Indian economy, the services sector is seeing a very strong demand in a lot of segments, real estate, travel, tourism, financial services, and that strength is going to continue in second quarter also. So we are expecting a 6.5% growth, mainly led by services sector, and we are also expecting some improvement in the manufacturing sector growth.
Okay, numbers led by services sector, 6.5% is your expectation with some improvement in the manufacturing sector. But you made a very, very important point and I was going to come to that. The previous quarter, as most of our viewers will see it, was a number of 7.8%. Even if we see a 6.5 or maybe like you said, may see an upside 6.6, 6.8 kind of a number if it comes like that, even then it would be a marked deceleration on a quarter-on-quarter basis. How should an average viewer really understand this? Is this really a deceleration? Have we, as an economy performed poorly when we compare it with the previous quarter? Or is it just to do with the kind of year-on-year numbers that we have been seeing and one really needs to calculate it on the base effect really?
Yes. So it's more a reflection of a statistical impact base effect. I wouldn't say it's a poor GDP growth number that we'll be seeing in Q2. Q1 was very strongly impacted by COVID, Q1 of FY21. And hence, even in the subsequent Q1s, we are still seeing the impact of that. And hence, the last Q1 number for FY24 Q1 GDP growth number was very high at 7.8%. And that's why statistically there will be a deceleration to 6.5% in Q2. But like I mentioned earlier, it's not really that the economy is slowing down. In fact, we were expecting a few quarters back, we were expecting that there will be some waning of pent-up demand. But on ground, we have not been seeing that. We are seeing very strong demand in some of the sectors, specifically services sector, some consumption items also, high-end, high value-added consumption items, and we continue to see strong demand there. So I wouldn't really say it will be because of slowing down of the economy.
Okay, fair enough. Just for all our viewers to see, where are all the top brokerage houses how have they pegged these numbers as an expectation? They will come up on the screens for you. So, for instance, ratings agency ICRA has pegged India's GDP growth at 7% for Q2. State Bank of India sees a 6.9 to 7.1% growth rate. Barclays India has expected Indian economy to grow at 6.8%, and the RBI, like I already pointed out, a 6.5%, and in consensus, Rajani Sinha also has a 6.5% number as well. You did point out about two subsectors, services that are likely to lead the growth and manufacturing, which is likely to be an improvement. But where do you think is going to be a big concern coming in? Is that from the agri sector? Are there other factors that you believe that continue to be a lag effect on the Indian economy?
So yes, you're right. One concerning aspect is agriculture sector. And this year the monsoon has not been good. It has been skewed. And we have seen the impact of that on the agricultural output. So the first estimate that has come of Kharif output that is already showing it to be lower by around 4% or so compared to last year. And even if we look at Rabi sowing, it has been lagged and we are seeing a fall compared to last year. So I think agricultural output is something, agri production is something which would be adversely impacted, and that is something which will pull down GDP. And secondly, also the external sector. This is a concern which has been there for a while. It's not specifically for this particular quarter, but overall global demand has been weak, which has resulted in our exports being adversely impacted. So I think that's something which is going to continue in the second quarter also. But at the same time, I would mention that while exports have not been performing well, our imports have also kind of gone down in terms of decelerated. So the net impact on net exports have not widened significantly. So that is a supporting, relatively comforting factor for GDP. But having said that, still exports will remain weak, and that will be a concerning factor for overall GDP growth.
Fair enough. Going forward into the Q3 and Q4 numbers as well, would you think that the consumption numbers would also add on to some kind of a support? We have seen an extended festive season, the domestic consumption trends, whichever we are coming, whichever are coming out from an informal way, say retail numbers have been coming out, shoppers, sales figures, they have come out talking about a positive consumption trend. Do you think they are a fair enough indication of perhaps what could we look at into the future quarters?
So, yes, consumption is expected to see an improvement, and we are seeing an improving trend. But here, the point to note is that while urban consumption has been very strong, it's the rural consumption which we are worried about. And that has been the story for quite some time that rural consumption demand has been weak. And it had just about kind of started showing some signs of recovery. But then now, with the monsoon not being good, there will be an impact on rural consumption story. So hence the rural consumption recovery that was expected may get delayed by that. On top of that, to add to the concerns on rural demand perspective, food inflation was also high till a few months back. So that will also have an adverse impact on rural consumption recovery. So consumption, the story would remain that while the urban consumption demand is very strong, it will continue to remain strong. Rural consumption recovery could get little delayed further because of poor monsoon.
All right. Ms. Sinha, also explain to us, while we all focus on the real GDP growth, the nominal growth or the growth in the GDP without adjusting for inflation will be an equally important number to track here too. So especially with for the government finances. So while the real growth in April to June quarter was at a 4-year high of 7.8%, it was the nominal GDP growth that had actually fallen to 8 odd percent, the lowest in 9 quarters. What is your own expectation for Q2 now, and what is the trend likely to be?
So, what is happening on inflation front is that while we are seeing CPI inflation moderating, if you look at WPI inflation, which also gives an indication of what to expect on GDP deflator, WPI inflation has been contracting for a while, which is the reason why, if I look at the GDP deflator, overall nominal GDP growth is turning out to be lower than what was the market expectation. So for the full fiscal year also, we think the story would be the same. We are expecting nominal GDP growth of around 10% or so. And that would mainly be because if you look at our WPI projection, while we are expecting CPI projection at around a little more than 5%, we expect WPI inflation to be less than 1%. So if you go by that, the indication is that GDP overall, if you look at GDP deflator, it is going to be a low number.
Okay, what else are you going to be looking out for in the latest growth data numbers? We've discussed a lot of subsectors, but anything else that is going to be extremely important for you as an economist and for viewers at large also to take note of?
The other critical aspect which we have not discussed as yet is what happens on investment front. So if we look at the investment story so far, it has been mainly led by government. And if we look at the government data also, state capex as well as centers capex has seen very strong growth in the last few months. So that is a good factor. But the very important thing which we'll be watching out for is what happens to private capex, because that's something which we've all been waiting for. Because if that picks up, that would be a true indication of growth being sustained. And this is where, we are getting mixed picture. When we track the private investment data, while we are seeing an improvement in private investment data, if we look at when we do corporate analysis and we look at their capex, we are seeing an improvement there. But at the same time, when we look at some of the data, like investment projects announced, which gives an indication of what is the intent to invest by private sector, we are seeing that going down in the last quarter. And that could be because of, policy related uncertainties, which now the private sector will expect with the elections round the corner. So that is something important to watch out for. At the same time, when you look at the order book of all these capital goods and infrastructure companies, you see that that has been going up, which is again an indication of likelihood of private capex going up going forward. So what happens to private capex is something which we would be critically looking forward to.
Absolutely. Private capex and how that picks up is absolutely important to really understand whether the growth will be sustained at these levels on the upside or not, or will there be other upside risks too. For the entire full year of financial year 2024, what is your expectation? Q2 you're saying 6.5%, but overall what is your expectation? What will we end the year with?
So overall, we are expecting GDP growth of around 6.3% for the full fiscal year. In fact, our projection was 6.5% earlier, and we lowered it mainly because of the monsoon being not too good, because of which, as I mentioned, the agricultural output has been lower, and we are expecting to see some adverse impact of that on rural demand, which will then get reflected in demand for a whole lot of things, including consumer durables and non-durables. So mainly because of this aspect, we have lowered the GDP growth projection to 6.3% for the full year.
Okay. Now this comes at a time when most of the global brokerage houses are actually raising India's projection of FY24 from earlier say 6% or sub 6% to now 6.3 and 6.4% as well. Recently we saw S&P Global Ratings revising India's GDP growth projection for FY24 to 6.4% from 6% earlier. UBS again had also marginally upticked their number to 6.3% as well, and most of these global brokerage houses had been believing that the robust domestic momentum could perhaps offset the negative headwinds that would emerge from say high food inflation and weak exports as well. But like you also pointed out, it is the rural recovery and the slowdown there that is perhaps as a bigger headwind. Will there be any kind of an upside risk or a downside risk to these numbers that you would see, that you have pegged?
So, Sakshi, as I said, our number was higher at 6.5%.
Yeah.
So, even when we are lowering it to 6.3%, it's in line with the projections that you were talking about
Hmm.
earlier. And
Hmm.
to that, I see there are chances of it turning out to be higher than what we are saying than lower.
Okay. The RBI's recent move to change the risk weight on consumer lending, has anything on that account also made you to change your expectation?
Not really. We haven't based it on that, but I think that's a good move which will ensure that this a lot of the consumption recovery that we have been seeing. There was concern that would it be sustained or is it like a bubble forming? It's too risky what has been happening in terms of personal loan growth. So in that aspect, I think it's a good move which will make the overall bank credit growth and overall GDP growth more sustainable going forward.
Okay, so I wanted to understand from you, what could emerge as a key trigger to perhaps take the Indian economy's growth much faster than what we are expecting, and what could be the key headwinds one needs to monitor. One you said is private capex. If that continues to pick up, then that would aid the sustained momentum on the upside. What else could help the markets or Indian economy really grow faster? At the same time, what could be the big headwinds, according to you, to the growth trajectory that we are seeing right now?
So let me first talk about the headwinds. So if I talk about the headwinds, I think the biggest concerning aspect would be what happens on the external sector.
Yeah.
Because if you see a lot of risk in the last 1 year have been arising from the global front. So that's something which we need to be cautious on, be it the growth numbers from US, EU, China. China is again something which we need to be careful of, specifically given what's happening in the property sector there and the impact of that on GDP. Because, these are big economies, and if they falter, it would have a ripple effect on many other economies, including India. So, on the global front, we really need to be cautious. Also, on the not just on the growth, but the impact on the banking sector there of the high interest rates. They are talking about higher interest rate for a longer period of time. So,
Yeah.
will the economies globally be able to sustain higher interest rate for a longer period of that? Are the financial systems strong enough to sustain that? So, those are the aspects that we need to be careful of. And then the crude oil price front. Right now, crude oil prices have gone down, but you don't know what could happen on the geopolitical front, which could again push up crude oil prices. So I think there are too many ifs and buts on the global front, which I would be more worried about. And now, if you ask me the positives, I think one big positive is that the urban consumption has been very strong in India. And for quite some time we were talking about, it's a pent up demand, and some of it is going to wane. But we are really seeing no signs of that happening. So that is a big positive, because if that continues, and in case rural demand is not much adversely impacted by this poor monsoon, then overall consumption could see a big boost, which would also be supportive of private investment picking up. Because private investment also, if you see the private sector as such, is in a good state right now to increase capex, because their balance sheets are in good shape, capacity utilization levels have risen. So if the consumption demand recovery, if that story is sustained, we could see a sharper pickup in capex than what we have factored in right now. So I would say
Absolutely.
those are the positive triggers.
Absolutely. And one last question to you, Ms. Sinha, and that would be that, we're joining and we are speaking on a day when the Indian equity markets have seen a historic high, $4 trillion mark being seen on the BSE listed stock markets. And this feat comes ahead of India's GDP, looking at a $4 trillion mark. How soon are we really looking at India's GDP really achieving this figure now?
So, see, GDP growth, I think we can expect a growth of around 7% or so for the next few years. Our potential GDP growth, we can say, is around 8%, which could be difficult, but I would say 6 to 7% growth is very much achievable. So 4 trillion, we are like almost there. That's not the question now. I think we should talk more about, when are we going to reach 7 trillion or 25 trillion? So that's the bigger question right now. But yes,
One
broadly, we can expect around 7% growth or so for the next few years.
Wonderfully said. Well, many thanks, Ms. Sinha, for being with us and sharing such valuable insights with all our viewers. Always a pleasure having you with us on Business Today Television. And many thanks for taking the time out for this show. And wish you a very good day. And with that, we will wrap up this special edition. Expectations on the Q2 GDP. Care Ratings, Rajani Sinha has pegged her expectation at 6.5% for Q2 FY24 GDP. There is a broad range of expectations on the streets, right from 6.5% all the way up to 7.1%. Will the markets get surprised with the GDP figures tomorrow is something that we will continue to watch out for. Do stay tuned on to Business Today TV to catch all the updates from the world of business and stock markets. Up until then, thanks for tuning in.